Welcome to the EBNet community, to this, the third episode of Inside Private Markets here on EBNet Stream. Today we're going to be unpacking private markets in a bit more detail, in a way that you can hopefully understand the risk associated with each of the private market options in isolation, but also very importantly to understand each one of the opportunities in the context of your fund overall. And why do I say that? Because private markets are decorrelated with traditional or public type markets. So even though there's risk inherent within each private market opportunity or type, overall, from a fund perspective, they help you diversify your risk. Hopefully, by the end of this episode, we've left you with an understanding of that. Please join us. Ladies and gentlemen, welcome to episode 3 of Inside Private Markets here on EBNet Stream. Today we're going to be unpacking private markets in a little bit more detail. What are the different options? What are those opportunities? What's the risk associated with each? And what applies to what type of investor? What questions should you be asking? Hopefully today we'll unpack that in a bit of detail for you. I'm joined by Associate Professor at the University of Cape Town, Francois Toerien, who is going to help me in this endeavor. Francois, welcome and thank you for joining us.
Morning, Leon. Thanks for having me, and hello to all your viewers as well.
So, Francois, before we get into the discussion, when I was having a look at your post, I was stalking you. I noticed that you did your PhD in chemistry, yet now you are lecturing in finance. Is that correct?
Yeah, that's correct, Leon. So it's literally a question of jack of all trades, and I'm afraid probably master of none. Very, very complicated background. I did transition briefly through the asset management industry, and yeah, now I'm teaching investment science, and hence my interest in private markets.
I just find it amazing how many people have done other degrees over time, or specifically this generation did engineering degrees or whatever it might be, but have ended up in the finance sort of circles. And I wonder whether that will continue or in fact reverse going forward, where people will be more specialized in that sense. But anyway, that's not the discussion for today, as interesting as it might be. So, Francois, the intent of Inside Private Markets is to help investors understand what the opportunities are and to avoid any pitfalls, the risks that are associated with them. Now, private markets is not as commonplace as the public markets for the average investor, and in particular trustees of pension funds who are used to delegating responsibility to their asset managers. Those asset managers invest in the bond markets, the JSE and so on. So I want to try to help these investors understand private markets better, because there are opportunities there, and we are highly underinvested private capital wise in private markets in South Africa, and that's really the intent of this series. So can I ask you the first question, which is just to give us a quick overview of what is private markets and how does that compare to the public markets?
Leon, so I think you're right. In South Africa, we very much uninvested in private markets, and I'm going to call it private equity, generally speaking here. You do get private debt as well, but that's a pretty new market. We underinvested compared to, for example, retirement funds in Europe, the US, etc. How does it differ from a public market? Well, the definition here is the private market or private equity is investing in unlisted companies, of course, and the bulk of the economy is actually unlisted in terms of number of companies, of course. How does it differ from public markets? I guess there are a few differences to bear in mind, and we will unpack. I think probably the most important one is issue of liquidity, of course. When you invest in the JSE, you can buy a share today, you can sell it immediately. In private equity, things take a bit longer, and I think I guess we will get to that. It really is. It really also allows you, and this is the other big difference and something to bear in mind. If you look at the Johannesburg Stock Exchange, 30 years ago there were about 600 something companies listed. We're now down to somewhere in the 300. So globally, less and less companies are listed. And as a result, you find a lot of opportunities you can only find in the private markets. So it gives you exposure to things, sorry, Leon, things like one of the big drivers at the moment is infrastructure, for example, something that you don't necessarily get exposure to easily on the stock exchange.
So one of the first myths that I pick up in talking to people is they tend to perceive private equity companies as being smaller than what you would see on the stock exchange. Now, that's not necessarily the case. There are some very, very large private equity firms that have just chosen to remain private. Yes, there's less liquidity on those firms, but not necessarily greater risk in terms of default risk or anything like that.
Correct. I think maybe just to take a step back and just maybe to explain the structure of a typical private equity fund. I think that would be useful in contextualizing a little bit. Because, I mean, how does it work? You've got three parties involved that you need to consider when you look at a private equity kind of ecosystem. In the middle is of course, the private equity company that starts private equity funds. And those funds are, I mean, they are set up by, call it investment managers that in the jargon of private markets, we call general partners. And they're pretty similar to your asset managers in a listed environment, except that they, of course, now go and invest money into companies that aren't listed. We call those the portfolio companies. And those companies, they can be small, but they can, as you rightly say, they can be very big as well. It doesn't have to be a small company at all. And private equity is often in the middle somewhere. And then, of course, there are the investors, which in this context we call limited partners. They contribute the funding, or let's say they contribute typically 98, 99% of the funding that's required for the investment. But 1 or 2% typically is contributed by the general partners, by the investment managers. So there's already an alignment of interest. They actually put some of their own money into the fund, which is actually quite a big advantage. Obviously, that's beneficial to the investor. The issue with liquidity, which I touch on, come in the fact that these private equity funds, in the main, not always, are set up as what they call on-commandite partnerships. And these are legal structures that have a specific lifetime. Most often, it's around 10 years, which means that if you invest in them, you are not absolutely, but to a large extent, the money is in there for longer. Now, for retirement fund, and we can talk about how to manage this, for retirement fund with a very long a lookout, very long investment horizon, that's not such a big issue because of that liquidity constraint, you'd expect a higher return over time than the listed markets. And historically, to some extent, that's what's happened.
Yes, I'd like to come back to the issue around liquidity, because to me it's probably the greatest risk that pension funds need to consider in terms of getting their heads around this investment opportunity. But just coming back to the unlisted markets and the investments that are made in that regard, and the concept of size. So you can have very large unlisted companies. You can have listed companies that are taken private. And these are all investment opportunities ultimately for pension funds or any investor to make. So it's not necessarily a size or a default risk that you're taking on, albeit the fact that there are lots of companies out there that are looking for capital that are smaller, but that's a certain class of private equity. So what I would like to do for the audience is, could I ask you to unpack the almost the phases of private equity, all the way from startup through to a more mature entity?
Okay, I think a useful way of thinking about that is looking at a company's life cycle. So the company requires funding. When you first start a business, you just got an idea, you one person or whatever. The only funding you're probably going to get there, with the risk and the uncertainties, you either have to fund yourself or family or friends or something. As the company grows a little bit, or let's say as the idea grows, you started getting sort of you sort of got prototype or whatever together, you get sometimes rich, wealthy individuals called angel investors that might invest and bring skills. But beyond that, as the company now, the next stage probably is what we call venture capital. And that is sometimes considered a subset of private equity, sometimes considered slightly different, and it kind of runs into private equity. This is one way of thinking about that is when the business is not making a profit yet, but is starting to grow. That's where venture capital comes in. Obviously, the risk is greater there because there are a lot of unknowns. It hasn't really been proven yet. But so is the potential upside if things go wrong, because at that stage, you're going to pay relatively little for a company that has potential, a lot of growth opportunity. So a lot of global companies, Microsoft and others, have had venture capital investments really early on. And you can see where that eventually goes. Of course, it doesn't always work. Subsequent to that, as the company grows, becomes profitable, and one of the options of funding then becomes private equity. And that private equity could be for growth purposes, for expanding into new markets, etc. Call it growth equity. And that might be why the company is looking for funding. Or it could be a change of ownership, buyout funding. Sorry, the difference being that, of course, the money going in for growth would go to the business to fund that growth and expansion and whatever is needed. Whereas buyout would be literally the money would go to the previous shareholders and the private equity company would invest in it. And that in this country has also been driven quite a bit by Black economic empowerment. The ownership, transfer of ownership has also often involved private equity helping to fund that kind of thing.
So I think that's a really good overview of the different types of private equity classes, if I could call it that, or equity classes in the unlisted space. Within venture capital, if I can just summarize again, these are almost pre-profit. They do have revenue on board. They do have a couple of customers. They've got a very good blueprint. And within that, you get series A, B, C type funding.
That's right. Yeah.
Can you explain that?
I'm not 100% familiar with the Series A, B, and C, but it's different stages of venture capital. So very early on would be Series A, then comes Series B. And I think these definitions are a little bit flexible as well. I mean, when I say venture capital, private equity is around where they become profitable. That's one way of looking at it. It's not an absolute. But yeah, there's a number of clauses. Series A, B, and C is, again, very early startup, kind of starting to become a more established business, and so on. Venture capital is a gap in the South African ecosystem to a large extent. There's not that much in it. And I also have to say, retirement funds in particular are very low. They're very, very small amounts going into private equity. And venture capital is a step even further, I think, at this stage.
So I think that's where I wanted to go with it, because within private equity, you then get to the point where you're capitalizing a business to grow, or you're helping change the ownership of that business. But when you look at it from an investor perspective, a pension fund. So let's say a pension fund is a long-term investor, and we'll come back to the liquidity debate. But they also are a fiduciary of other people's capital. So in general, risk averse in the nature. However, so from that perspective, you'd say that if they're going to invest in private markets, it should be to the higher end, where default risk is lower, the businesses are more established, and you should definitely get a return on your investment. In Europe, though, I've noticed more and more the pension funds starting to put the toe in the water as far as venture capital is concerned. And I think a large part of that is also because of impact investing. So impact, where you're trying to ultimately get a particular outcome to solve a world problem, that there might be social or climate or whatever it might be, where there's a good idea, but the business is still early in its phases, if I could put it that way. And funds or institutional investors are starting to support that kind of initiative, because it fits in with their own philosophy of how they want to contribute to society. That we're not there in South Africa. A lot of people talk about the missing middle in terms
That's
of
right.
funding for different companies and so on. So how do you see that, and how do you see that progressing in South Africa? Do you think it'll be similar?
Sure, Leon, you've now touched on about 10 things I can talk about. First of all, just very briefly, the idea of having an impact, impact investing, making a difference to the economy, growing entrepreneurs, eventually having an impact in the economy. I think that's a big, big driving force, or a big reason for, or motivated to get involved in private equity and venture capital as well, because it really does make a difference. The big driver in this country, I think, in the last while has been infrastructure. So investing in projects that have economic benefits for the country, but at the same time, obviously, can get you often very safe returns, because there's ongoing income from those if it's correctly set up, especially the energy, wind farms and things like that have been a big driver. So there is impact there.
I thought now would be a good time to take a break and listen to a quick word from our sponsor, Old Mutual Alternative Investments. As we unpack the different types of private market investments, it's always worth remembering that impact investing is one of the fastest growing segments, not just within private markets, but private markets are often associated with impact investing. So what is that? Impact investing is about not just producing financial returns at a certain level of risk, but also targeting meaningful social outcomes, i.e. development or solving for certain problems that we face, be it as a planet or within our society. Old Mutual Alternative Investments is active in this space, and this video focuses on EduFund, which seeks to expand access to education. That's a good cause. Let's take a look. And if you enjoy this video and are enjoying the series, please give us a thumbs up and subscribe. We will truly appreciate your support. Thank you.
My name is Kelly Joshua. I'm the head of education investing within Old Mutual Alternative Investments. Through its education funds, Old Mutual Alternative Investments aims to increase access to affordable quality education. By doing this, we provide greater opportunities to our youth. We can potentially end the cycle of poverty, as well as stimulate economic growth. When assessing an opportunity, the performance of a school is highly dependent on the track record, experience, as well as composition of the operating team. It is this team's responsibility to ensure that the teachers, facilities, and systems all support quality education outcomes. It is this team's responsibility to ensure that the teachers, facilities, as well as systems all support the education and development of the child. So beyond pass rates and headline results, my team and I hope to build schools that support the holistic development of a child, which includes adequately preparing them for the future of work life as well as active citizenship. The fund's primary impact is the creation of affordable quality education facilities. Achieving our desired impact forms the foundation of any school business. So effectively, there's no trade-off between the two. If you do not provide a value proposition to a parent that is attractive and includes quality education, you're effectively going to struggle financially, and the long-term sustainability of the school will be compromised. Since the fund's inception about more than 10 years ago, there have been so many lessons learned. Off the back of those experiences, we have made strategic shifts in the strategy of the fund to support improved financial as well as social impact outcomes. I'm excited about how this is going to evolve and the opportunity to create large-scale positive impact on society. The fund is incredibly proud of the matric results achieved this year. We've seen significant improvement of some of our historically struggling schools, and more than one school has finished top in the district. A special mention, however, has to be for Kamagelo Chabalala from Akudeo College, Kirkney. He was awarded the top learner in matric from an independent school in the country, and in Gauteng he was the top learner in mathematics with a 99% pass rate. This is an exceptional outcome, and we will continue to support him in any way we can through his tertiary studies as well. We intend to keep up this positive momentum and ensure that our schools go from strength to strength.
Will it change over time? Will we get more involved? I think we're already seeing it, starting at the private equity side. I think it's especially, like I said, impact and infrastructure. And just on your venture capital point, one of the countries in the world that has the strongest venture capital ecosystem is Israel. And their economy is taking massive benefit from that. Their technology, their value add that they have in that economy is second to none. And a large part of that is thanks to their strong venture capital ecosystem to support those entrepreneurs. Unfortunately, in this country, and I think maybe similar to much of continental Europe, we're quite conservative. If somebody fails in a business, we kind of write them off. Whereas my perception is in the US, if you fail 3 times, they reckon, well, you've learned your lesson, you're now worth the go. So it's also kind of cultural thing. So yeah, it's something that might take a bit of time, but I think it's starting to change slowly. We're seeing that the opportunities are there, and the opportunities in the listed markets are, actually slowing down. Even big companies, like we said, are not necessarily listing anymore.
Why do you think it is that companies are choosing to remain private for longer, or actually going private, and therefore we've seen the reduction in listed companies?
I think you need to look at it from 2 sides, right? So the one is, do they have an alternative to getting listed? And more they are getting funding elsewhere, especially as the private equity industry grows. And the second is, being listed is actually quite onerous for a company, not only in terms of all the regulatory requirements that are obviously quite onerous, or the auditing you have to pay for, and all that kind of thing. But actually, if you're a listed company, your flexibility is a lot less, because the market is watching you all the time, looking for short-term profits. We have to report every 6 months. Analysts are on your case all the time. There's management time that goes into that. And I do think if you stay private, you're not as pressured to take short-term decisions. You could think longer term. The market just puts an enormous amount of pressure on one, that the public markets. And I think people often miss that.
Yeah, I think you're spot on. I mean, the average tenure of a CEO in America is something ridiculously short. I mean, how on earth they ever expect a strategy to come to fruition in such short periods? And there it's about quarterly earnings. I mean, we're not even that bad here in South Africa. But being a listed company, there's a lot of, I don't know if scrutiny is the right word, but it's almost a lot of unrealistic expectation sometimes in that respect. So I can fully understand why companies are remaining private or going private. And at the end of the day, if you're an investor, if you're a pension fund and you've been investing in the market for years and years and years, you used to have those 600 stocks that you could get access to. And the asset managers, and we've always had a concentration, the top 10 manage like 2/3 of the pie at the end of the day. They are now constricted down to a lot less, half of that amount, which means you're going to get them all investing in the same stuff. So if you don't actually diversify into the private markets, you've limited your opportunities, your return and your diversification opportunities. So from a return perspective, would you expect a private company to produce a higher return than a listed company? And I'm talking in general now, because obviously you've got the extreme.
Yeah. I mean, I'm not sure whether I'd say that the fact that it's private will give a better return than a listed, depending how you define return. But if you invest in private equity as an asset class compared to listed equity, over the long term, on a theoretical basis, I mean, it's been shown to some extent historically, but it's not a guarantee, obviously, that it should outperform over time. Simply because, like I said, already you have the liquidity issue, which we'll talk about, which means that you will pay less to make up for that. So your returns your returns should be higher over time. The other thing is diversification. The private markets are not necessarily correlated to the public markets. So there are different things driving them, especially if you get access to those opportunity sets you can't get elsewhere. As you rightly say, our listed market is now highly concentrated, not only in asset managers, but in companies on the stock exchange. The Naspers and those guys, that dominates the stock exchange. So you're actually also not as invested in South Africa as you might think. And South Africa is doing quite well at the moment, because a lot of income from those companies on the JSE are actually foreign derived. You now have much more, the bigger guys are mostly multinational kind of companies. There's one other thing I want to mention that came out of what you said. On a listed environment, you've got a very diverse shareholder basis, right? So you've got an Anglo-American, you've got thousands of shareholders, tens of thousands. So there's not that much control of what management does. So as an investor, you're very far removed from the decision making through the board, through the asset manager, etc. Private equity is a little bit closer, actually quite a bit closer, because your private equity firm directly invests. They typically take a fairly big stake, if not kind of a controlling stake. Normally, maybe not controlling, but very influential. They sit on the board. They get the management accounts. They do not only bring money, if they're good, let's say if they're good, and if they got a bit of track record, they bring more than money to the business. And maybe that touches a little bit on that outperformance question you asked. They also bring, if they got the right experience, which is one of the things you want to look for when you look at private equity, they also bring skills, and they potentially also bring networks and bring in structure, etc. So it's more than just the money that they put in. I mean, from a business point of view, private equity isn't cheap, because the investors take quite a big stake and they're not going to pay a huge amount for it. And that, of course, is advantageous to the investor. But yeah, they bring more than just money to the table.
So you've touched on the other, call it bugbear, that investors have, which is the costs associated with private equity. But I think we need to create the right understanding of it, because first of all, we've somehow lumped private market investing under the term alternative investing, and we put hedge funds in there as well. And the hedge funds charge high fees with high carries or performance fees, and did exceptionally well off the back of that. Now, private market fees are similar. Often we talk about 2 and 20, so 2% per annum, 20% of the outperformance of a particular benchmark. So it's similar in that respect. But these are fees that cover a lot of expenses that would normally be within the wash of a listed company kind of thing. So marketing expenses, this and that, and so on. So they are fees that aren't just to the GP or the asset manager. They aren't earning all of that. And also they ultimately are targeting that return premium post those fees.
Correct.
That needs to be considered. It's not 2% premium and then you take your 2% off.
Let's and I think that's very important. And you're right, that is the other big thing. We're still parking liquidity for the moment, but from a costing point of view, maybe just to work through how the fees and costing work, and also the alignment that it creates, because I think people miss that bit. So how a private equity fund's fees typically work in the main is there's a management fee, and it ranges from 1 to 3 typically in the market, but it's normally about 2% of assets under management. In fact, maybe if I can just reverse slightly, because there's another important thing we just need to talk about here. When you invest in a private equity fund, you don't put the money in immediately. It's called a commitment, right? You as 10 million, 100 million, whatever you sign up for, you don't pay it in immediately. You have a process called drawdowns, that when the fund needs, when they've got an investment they want to make and they need they need money for that, they will let you know, and you have to pay in as per your commitment a certain amount. And that drawdown typically takes place over the first 5 years of the fund's, let's say, 10-year lifetime. And then after that, they've made the investments, they work on those companies, they improve their value, and there are various ways which we can talk about how they do that. And then they exit, and you get your money back as they exit. So that's important to understand, because for the first 5 years, typically your 2% management fee, which is there to cover the costs of the fund. That's the main purpose of that. That's determined on the commitment that you've made. And normally the second half is on the actual investment amount. So that's throughout, let's say 2%, argument's sake, that you pay to keep them going. There's a lot of expenses. I mean, we don't have to go into that. However, the big upside for the general partner, for the investment manager, is something called carry, which you can think of as a profit share. But before you even get to that, there's normally what they call a hurdle rate that's agreed to up front. That's a certain minimum return required on the money that's put in by the investors before any profits are shared at all, right? So they first have to meet that minimum target. And the other important thing is that carry, and that's typically in most instances, the industry standard is 20% of the profits after the investors got their money back, plus the required return, which I believe is about 8 to 12% in the market at the moment. Only after that do the general partners get any money back. As important is that they only can cash in on that carry. It's determined on a cash-to-cash basis. So you also have performance fees in a listed environment, but those guys get performance fees even though the shares may not have been sold yet, just on the current market value, which means tomorrow it can halve in value. You still pay those performance fees, and of course we know there's only a one-way kind of direction on those. They don't go back. Whereas with private equity, the profit share only happens when the cash is in the bank, when it's a definite given. The other thing that's important to understand is because it takes a long time to unlock those profits, I mean, the first 5 years you're still making investments. The big upside for the general partners, for the investment managers, is back-end loaded. They only get at the end. So that incentive is there till late in the process for them to really outperform. So it really aligns the interest. That, plus, as I said earlier, some of their own money is involved in there as well. But their big upside is towards the end of the fund's lifetime. So they've got an incentive to work to everybody's benefit all the way through.
So if I can quickly unpack then the process with the GP. So a GP will decide to launch a fund of some sort.
Yeah.
That fund might be based on type of private equity investing, like buyouts or growth stocks, or in the VC space. It might be focused on a speciality. It could be IT and communications, whatever it might be that they're targeting in the way of companies. But they would then do a fundraise. So they would market this fund that they're raising capital
it's like
for.
18 to 24 months, the marketing. Yeah, they go out and look for funding, correct.
And that is what they will call close one. So they will close at one date where the investors make a commitment, sign a document to say, we will give you when you need the money to invest. They will then ascertain what deal flow companies they can find to invest in that are suitable to the mandate, call on the investor then to start transferring money across, and they'll start deploying that money into the companies. They will then work with those companies to make sure it's deployed correctly, that it's achieving what it's meant to achieve. And depending on how well the deal flow is going, they will then have another fundraise from the same investors or other investors, and that could be, say, close two, that people then commit to. And that process continues. Maybe there's even a third close or whatever it might be. But the money then goes into the companies over, like you said, those first 5 years. Then they start ultimately seeing the fruits come through with call it the bullet payment on exit, be it 7 years, 10 years, whatever it might be. Are there dividends earned over that period?
Yeah, there could be. That is one of the sources of return. There could be dividends earned from those companies. Obviously, it depends on the companies. It might not be in the interest of the investors to earn dividends if the company, that funding can be used to grow the company. But yeah, dividends definitely are a possibility.
Now, how do they exit? So is it guaranteed after the term you're going to get your money back, or do they need to find a buyer?
Okay. So you've touched on a few things there that are important to understand when you first get involved in a private equity fund. And I just want to touch on those lest I forget. The one is, at that first close, there will be a limited partner agreement between the limited partners and the general partners that kind of like a mandate for the fund. So you certainly want to look at that very carefully. So that's the first thing. You mentioned deal flow, very important to look at the private equity general partners. Do they have their deal flow? You don't want them to start looking for things once they've got your commitment. So you are going to be interested in what deal flow they're looking at. In terms of speciality in South Africa, many of our private equity funds are still kind of generalist because our market isn't huge. They're becoming more specialized in specific sectors. Again, infrastructure, energy is a big one there, and impact. Right, exit. As important is to be sure that they've got exit plans. It's useful to see if they've got a bit of an exit history. If they do, it's helpful. They should be looking at exiting at the optimal moment, whenever that comes around. And very often the private equity funds, again, if they're good, they really should, as they invest, they already should have an idea of 2 or 3 possible exit plans. And in fact, if they do it well, they will structure the whole company such as that make it suitable for that exit. So they actively plan towards that. In terms of how exits, what exit opportunities there are, and this is one of the critical things around private equity. There's no point in investing if there's no exit, and that's the challenge. Most exits in South Africa are in the form of what we call trade sales. So it means that the equity is sold to another business for strategic reasons. Let's say it's a investment in a company that makes automotive parts. So you might sell that to an automotive company or I don't know, some kind of fast food place that fast food brand that there's an investment in that would then be sold to a big franchise operator, for example. More and more, we are starting to see a bit of a secondary market, what they call the secondary market, which is one private equity fund perhaps selling the investment to another private equity fund, especially if they've got specialization in certain stages of the investment. That happens a lot more in developed markets like the US, where you've got a much bigger ecosystem. And yeah, those are probably the main ones. Sometimes there's a management buys out the company using debt, which is called management buyout. We very seldom in this country get the big, what they call IPOs, right? Companies being listed, going public from private. The big ones in the US, that's the favorite exit strategy, but we don't have a lot of that yet.
Okay, so that's useful for. I'll often say to investors, also consider when you're choosing the class that you want, be it equity, debt, whatever it might be, infrastructure, choose the risk that you want exposure to or that you can tolerate. But now you also need to choose the specialization. Is it a particular industry or whatever, based on the fund and the fund that's being offered? But also you need to look at your GP. So do they have the requisite skills? Do they have the deal flow in place? They don't have to have every single deal, but they need to have a decent pipeline of deals. Otherwise, your money will just sit waiting for them to hopefully come call on it, and you won't get the returns. But also, you need to look at the maturity of that GP. Now, if you're an earlier stage investor that can take on more risk, investing in a first fund offered by a GP could be fine. But otherwise, perhaps look for the track record that they've done 1 or 2 funds and that they've succeeded in deploying the capital, exiting at the end of it, and so on. So any comments on that?
No, that's absolutely correct. If it's an earlier, a GP with relatively little experience, they probably won't have the bargaining power, and you're going to get in at a cheaper rate, lower management fee, maybe even a smaller carry. But obviously, there's greater risk because of the lack of experience. Having said that, it's not only of whether the private equity firm has started a fund. It might be just looking at the people themselves. That's ultimately what you're investing in. They might have experience just at other funds or other operators, and they went off and did their own thing. I guess it's the same in the listed space. So I agree with you. You'd certainly want to look at that. And look at track record. You don't want them to have no idea where they're going to go when you commit. And the other thing you also want to understand is, the so-called key man events or key person events. You are investing in the team. So one of the things you might want to look at in terms of the limited partnership agreement up front is what happens if core members of the team leave, can you take your funding out? How does it work? Because that's probably one of your risks. Same, I guess, in the listed environment with asset managers.
Yeah,
Maybe just
it
before I
is
forget,
this.
Leon, before I
Tony.
forget, just one other thing. If you think you're going into a private equity fund, obviously you're going to hopefully do due diligence, or your asset consultant, whatever. There is an organization called the International Limited Partners Association, ILPA. They do a brilliant, very, very comprehensive due diligence questionnaire. If anybody's interested in finding that on their website, ILPA is the
I'll
organization.
include that in the description to this video. It's a very good
Okay, cool.
guide, if I could put it that way. But on that point, the due diligence of a GP is similar to the due diligence of an asset manager in the public space. It's around competency, track
Absolutely.
record, history, ethics, licensing, quality of administration. All of those things are not so much tick the box, but all critical elements. However, in my opinion, and I might not get all of them, when it comes to private markets, there's a little bit more emphasis that needs to be placed on deal flow, like you identified. A little bit more on the track record of those individuals. It's less the company, more the individuals in this case. An understanding of the fee and how the fee will ultimately work.
Yes.
Then the legal agreements, because you can access these investments, and we've got an episode specifically in the series on how to access private equity, private debt, and so on. You can access it through life company type vehicles, right, which makes the paperwork, I suppose, a bit easier. I suppose even these days, maybe through an EFT down the line, you'll be able to access these kind of vehicles. But otherwise, you entering into, and I won't get the pronunciation right, these LP agreements, and underlying that are these in commodante partnerships and so on. And that is quite complicated. And it requires quite a lot of legal work, and there's costs ultimately that's associated in doing that legal work, both as the GP, which you're paying for through your fee, but then as the LP in assessing your LPA or LP agreement.
Correct. Yeah. I mean, I can't add much to that. I think you're right. We are moving slowly into an environment where we will have more options of getting in. I see there's a secondary fund that started a year ago or so that will buy out. It seems investors want to get out of these long-term commitments, but at a discount. And eventually, I guess we will find ways of making it more liquid and getting out. But there is that work to be done up front. And I remember now what the other thing I just want to say, there's a perception that these markets are less regulated than the listed environment. And yes, it might be less regulated, but it is definitely regulated. We've got Regulation 28 that limits you. And specifically, if you're a retirement fund and a board notice 1 of 2012, if you are to invest in a pension fund, that pension fund needs to, not a pension fund, in a private equity fund, that private equity fund needs to meet certain criteria. Valuation, there's specific valuation techniques that they have to use. They have to have an advisory board. Those valuations have to be audited once a year by an independent party. So it's not unregulated in that sense, especially if you're a retirement fund. So they have things they have to comply to. Oh yeah, and they do need a FIS 2, regular license. Yeah.
Yeah. So same as a normal asset manager at the end of the day. In fact, I think there's some more onerous requirements as well in terms of it, but that's not that important for now. Just quickly on, I want to come to the liquidity debate and discussion.
Yes.
So to me, that's the critical question for a fund to ask. So you're spot on earlier. You said a pension fund ultimately is a long-term vehicle in its nature. It's investing for 30, 40 years down the line. So having a portion of your fund, call it locked in to a private equity type vehicle, even though it's not truly locked in, it shouldn't be an issue. Okay. However, you have members coming and going.
Yeah.
So if you were a fund with very few members, and if one member left, it took 50% of your assets, well, that would be problematic, because suddenly that means the rest of the members are stuck now with far higher weighting and therefore risk exposure to private markets. So you've got to be careful on things like that. But that should be the exception rather than the norm. But where there is a big debate that needs to be considered is the concept of umbrella funds. So in South Africa, we're seeing this consolidation of standalone administered funds. So it's the employer's fund. And then there is these sponsored funds, these umbrella super type funds that have been put together where multiple employers are participating. Now, there the same concept comes to play in the sense that if you have a particular participating employer that makes up a significant portion of the total umbrella fund, if they chose to move or if they were liquidated, that means the remaining employers in that fund could suddenly end up overweighted. So there's a concern there that I think is real, but this is where the consultant needs to come to the table, the investment consultant, and say, right, let's model that. Let's have a look at what those chances are of those things happening. Do we have anybody more than X% of the overall fund and so on? So they're all solvable issues, or at least to get to an answer in terms of it. And even in that regard, it doesn't mean that it's totally illiquid. I mean, you can always move if you're moving between one fund and another as an umbrella fund. You can take those shares, the actual exposure to the private equity with you as a fractional ownership, essentially, in terms of it. Or there is a secondary market starting to come about, but you might end up paying a bit of a penalty if you needed to cash out sooner. So the liquidity debate, I don't think you've got anything to add on that, but I think it's a critical one, but a misunderstood one, if I could put it that way. And it's too easy an excuse not to invest in a great opportunity.
Yeah, I agree with that. I mean, it is a relevant thing. You do need to consider liquidity, but you're not going to put a large part of your funding into private equity anyway. I mean, that would not be a good idea. I mean, there's going to be a fairly small part. It's going to give you diversification. It gives you upside, gives you exposure to other things, and it might tick some of the other boxes that are important to you. The ways of trying to manage to the extent that it is an issue. The one thing is you can get an idea of the cash needs. So it does mean that you have to manage to have the money available. You don't have to have it in, but it does mean you don't have total flexibility on those funds that you're holding back. But the general partners should have an idea of when they're going to need the funding. So you should be able to get a quarter to 6 months ahead kind of indication from them. So you can do some planning around that, first of all. The bigger you are, of course, the more flexibility you have around these things. Fund of funds, we don't really have them yet. It's still starting to come in where you could invest at a higher level, but then you have extra fees, perhaps. The other way to go about this, once you're really into this, is to have investments. And again, it talks to a little bit of bigger investment than when you first start. But is to invest across the life cycle of these funds. If you have an investment in a fund that is towards the end of its life cycle and is starting to pay out money, and at the same time you now invest in a fund at the start of its life cycle that absorbs that money, you kind of net out on it. So that's what a lot of overseas private pension or retirement funds do, is they spread their investment across the life cycle of these funds. So that kind of, the one generates cash and while the other one absorbs it. And so you grow your portfolio.
So to summarize the discussion before I ask one or two other, call it nuanced questions, is that as an individual or as a retirement fund, there's a range of different private market opportunities that are there. There are opportunities. They should produce and probably will produce higher returns given their nature and the risk profile of it. You got to choose which risk profile suits your needs. So maybe as an individual investor, you have a higher tolerance. If you've got the wealth, you can invest in early stage VC or angel type investing, but that's not really for a pension fund. A pension fund needs to look at more mature companies where there's lower default risks. There's call it a tested thesis in terms of those companies. However, there is scope for later stage VC for pension funds as well, because a pension fund is investing for the longer term, and it's about development of the economy, the opportunities, job growth, all of those things, so that a member retires comfortably in the future into an environment. So to support earlier stage means you're actually supporting the member over the longer term and your ability to continue to produce returns in 30 or 40 years, because a fund will be around for even longer in some cases. So that's where the risk profile needs to match the risk profile of the investor versus the asset type that there is. And we focus a lot of our attention on equity, but obviously there's private debt as well.
Yeah.
You mentioned infrastructure, there's real estate. Each has its own nuance, and a consultant can lead you to determine which is most appropriate for your needs. Across all of them, there are great opportunities, and the listed market is shrinking. So it would be almost, careful my wording here, it would almost be irresponsible if you didn't at least consider what's happening within the private markets as a fiduciary of others' monies. So that's my summary of the conversation that we've had, not biased in any way whatsoever, but I have no ownership of anything private equity, asset manager, or anything related in that sense. So no bias on my side. Let's take a hypothetical example. Vanguard comes to me. I'm a pension fund. They say we're raising capital for a science and technology fund. Part of our deal flow, and I'm just making all this up, is SpaceX. Okay, great opportunities. I'd like you to commit, I don't know, $1 billion, or whatever it might be, to that investment. I then say, okay, fine, but I'm a pretty sophisticated investor, or I'm not stupid around these things. They then say there's also a co-investment opportunity. Right? So what is that, and why would I consider the so-called co-investment opportunity?
Okay, so what we've been talking about so far is investing into the private equity fund. Your money goes in there, you pay your management fees, etc. Now, what sometimes happens is that a private equity fund has a great investment opportunity. They've made the investment in there through the fund, but because they are restricted in terms of their mandate, they cannot put any more money into that investment, which they presumably know well and which is a really good one, but that company still needs additional funding. A co-investment opportunity is when they come to you and say, look, we need more money to be invested in this company. The fund can't do it anymore, but you can do it directly. So co-investment in parallel, you can put some of your money directly in. The advantage of that, if that does happen, is that you won't be paying management fees on that part of the investment because it's not going through the formal private equity fund vehicle. But you sort of still benefit from the private equity oversight, from the fund manager oversight, because they are invested through the fund. So if that happens, it's something you might also want to look at when you look at the limited partnership agreement up front. What does it say around that kind of thing?
Also helps them fill the boots that they need in order to make the investments, to meet the capital requirements that perhaps the fund hasn't managed to sufficiently raise.
Yeah.
So it's in everyone's interest, essentially, if you did.
Correct. Yeah.
Okay, good. So I'm trying to think what we haven't covered. I mean, I'm sure there are many things that we haven't covered within this, but I think we've covered enough just to give a good feel to the audience around what these investments are all about. So maybe we can close off today by just talking a little bit about the maturity of private equity and infrastructure investing in South Africa. Now, in the second episode, I interviewed Paul Boynton, who I consider as being one of the, what's the right word? Not inventors of, but early stage private market type investors in South Africa, or involvement in that market. There's an acceleration more recently because of impetus from government, specifically around infrastructure, because we need that infrastructure development, and we also need the entrepreneurial development to create jobs in South Africa. So they have relaxed the regulation 28 to allow for higher exposures. I think it's 45% infrastructure, 15% equity. So the first question to you is, why that difference? Why 45% infrastructure, only 15% equity? There's a clear message within that.
I can't speak on behalf of government, but I could see that 45% of, and I know there's some confusion as to exactly how that adds up to 45%. You're right. The big driver here is government recognizing that it does not have the resources, the capability to satisfy the infrastructure needs of the country. And I mean, that's pretty critical for our economic growth going forward. And so Regulation 28 was relaxed on both those grounds, so that in the hope of accessing retirement funds, which is that's the biggest part of funds in the country, to get involved in this infrastructure. Why it's 45? I don't know why it's that high, but obviously they want to encourage infrastructure investment across the board. But understand, as I understand it, that 45% is infrastructure in whichever way. So there is a pot for bonds, corporate bonds. There's a pot, obviously, for listed equity. And I understand it to the extent that you can get infrastructure exposure through listed equity, which is actually, in my opinion, quite limited. That would also go towards that 45. I mean, nobody's going to get even close to that. I mean, I'm not quite sure why it's that high. The 15% private equity, yeah, that's gone up from, I think it was 10%. Partly because they want to encourage private equity to go into infrastructure, because that's the clearest and the cleanest and the most common vehicle to get to infrastructure. But of course, it's more than just that, as you rightly said. There's great investments going into education as well, into technology and so on.
Also, we mentioned diversification earlier, and you said there's low correlation between public and private markets, not just in terms of the return stream, but also in terms of the types of investments you can get exposure to. I mean, you mentioned education as an example. There might not be a significant pool in certain specialities on the listed market that sometimes the private markets can unlock for you. Maybe it's energy or something like that, where there's a call it a specific need within the country, and therefore private capital is heading in that direction.
Yeah, I mean, definitely that is the case. Sorry, I missed a little bit there. I got distracted for a moment. If you can just repeat that.
Not serious. So what I was trying to say is I find that there's different asset opportunities or different I'm trying to think the right sector opportunities is perhaps the best way of putting it, that not always fully represented in the public markets, where you can get very interesting diversification across different industries in the private market space as well.
Definitely. We said, obviously, there was the infrastructure is a big one. Private equity invests across the board. Energy is a big one out there. Technology, your earlier stage technology. In South Africa, there are amazing entrepreneurs out there. Funding has been our problem. As I understand, in the US, it's kind of the opposite. They now got a very big private equity industry, and they're actually overpaying because they're so relatively few opportunities to invest compared to the amount of money chasing it. We've got the opposite issue. A lot of entrepreneurs out there with ideas, with businesses that are ready to grow, to go international, etc. But they can't access the funding. So in a way, it's probably a good time to get in now, while there's still an excess of opportunity and a lack of funding. As the industry grows, that probably will change as well. Maybe that's another thing, Leon. I actually forgot about mentioning that earlier. Obviously, private equity markets are a lot more inefficient than the public markets. And what I mean by that is public markets, when information comes around, there's lots of information around, people can easily value the opportunity. So they normally you get relatively fairly priced. Whereas in the private markets, there's not a lot of information. If you're a good private equity investment manager, general partner, and you know the market and you've got good networks and deal flow, you can actually get some really good bargains if you know what you're doing. Just because the competition and the information and is less for those opportunities.
It also forces you to be closer to management of companies, because you don't have that information flow, which means you've got to have the right skills to be able to facilitate that. It's, again, different to just a public markets analyst. When I say just, it's different in that sense.
Yeah, absolutely.
So when I look at the GP landscape in South Africa, it's mind-boggling. I mean, you've got as many private market GPs as what you have, call it traditional asset management companies, in terms of, call it established entities at the end of the day. But there's well in excess of 50 registered GPs, probably closer to 100 at the end of the day. Now, we look at that and you think it's very mature, but a lot of these guys are still quite subscale and seeking capital ultimately to get funds up and running and so on.
Correct. I think that has been the challenge, is getting the funding. Certainly retirement funds in the country are growing their contribution, but if I remember correctly, in 2023, there was about 250 billion was the size of the industry, compared to a retirement fund industry of 4.5 odd trillion rand, if not more, 5 trillion. So it's still very small relative to the funds out there, but they're not getting those funds. I think it's about a third of the funding that went into private equity. I just need to think this through. I think it was about 30 billion or so that went into private equity in 2023. And of that, retirement funds was about 6 billion. The biggest investor that year was development finance institutions. So you get these international institutions that put funding into developing countries' economy and so on, and they big investors, but there's still a serious lack of funding.
But it's difficult. It's difficult to know where to go to understand these things. I mean, you have performance surveys that are produced in the market on the, call it the general asset management space or traditional space, where you can see Alan Gray, Coronation, 91. You can see the list of who all of those guys are. That's not commonplace. No one knows who's raising assets by when. It's sitting currently between a GP and an investment consultant, perhaps. All right. And that's not now getting out there broadly to stimulate understanding and interest in terms of that. And I think that that's a fault. And I think that the private equity community needs to collaborate more to start creating a broader awareness of who's got what, who's doing what, and who's capable ultimately of what, so that pension funds can have move beyond, should we invest in this asset class, to what do we want to get exposure to? What are the interesting things that are there? What are those opportunities ultimately? And I think we all have a role to play to create that awareness.
Yeah, I think that's a fair comment. I think there's a lack of information, understanding out there. You're also right. The asset consultants are the gatekeepers on these kind of things. So it depends on their attitude towards the asset class, how conservative they are, etc. Obviously, we do have the South African Venture Capital and Private Equity Association, SAFCA, and their members. I mean, if you want to get an idea of who the private equity guys are in the country, it's probably a list of their members. So their website also, like you say, has information, the kind of stats that I threw around here. Not that I remember many of them, but they do a survey once a year of the industry as well. So that's the one resource. But there's still a serious lack of knowledge, of understanding of the industry out there, and we do all have a role in that. I agree with you.
Yeah. Well, Francois, I'm going to have to close it there. I'd love to keep on chatting, but I'm well over time again in terms of this. But I mean, to me, I think this is such a crucial conversation, not just for the sake of pension funds and their investment opportunities, but for the sake of the development of South Africa and the health of our economy and all the people. Our ability to economically transform is all reliant on growth at the end of the day. That's the reality, and herein lies an opportunity for us to achieve that through greater private capital into our private markets. So I thank you for taking the time to be with us today and sharing your knowledge. Every little bit is going to move us further in the right direction, as I see it. So thanks for sharing with us.
It's a pleasure, Leon, and thanks for inviting me.
Yeah, all the best and keep well. Bye-bye.
Cheers, bye.
Mr. and Mrs. Cupcake want to have their cake and eat it. They have a successful business, but in order to expand overseas, they need some cash behind them. A normal bank loan won't cut it, as it's too risky and complicated for a high street bank to deal with. And floating on the stock exchange would require them to be a much bigger player, and they're not there yet. But there is another way. Meet Mrs. Finance. Mrs. Finance's job as a private markets investor is to invest in or acquire non-listed businesses or assets, transform them significantly, and sell them. And luckily, she loves cake. Who doesn't? And the food industry is her speciality when it comes to investments. But to help these businesses grow, she needs time, usually 6 to 9 months to get to know the business. Doing this due diligence helps her understand the company and value, and she can come up with a plan on how to grow, improve, refocus, or expand the business. At the end of the day, she'll be rewarded when Mr. and Mrs. Cupcake execute the plans and the business thrives. There are many different ways an investor can invest in private companies. Mrs. Finance basically buys a stake in a company in exchange for cash. Early on in a startup, it's called venture capital. For developing a profitable business, it's called growth equity. And for a more mature company looking for new owners, a leveraged buyout is common. In that case, Mrs. Finance uses debt to acquire the business, just like she would to buy real estate. But what if you don't know the industry, but the opportunity appeals? Well, you can team up with like-minded investors and pool your capital into a private market fund. Mrs. Finance will invest it for you as a fund manager by applying her expertise and know-how to select the most promising opportunities, lead the transformation, and sell, hopefully generating significant profit. Not only will you get a share of the profits, but you can also benefit from the diversification, as the fund will be spread across several different projects. You can pick and choose funds to tailor your exposure to different regions, industries, and company development stages. Mrs. Finance will be paid for this work through a combination of recurring management fees to pay her salary and performance fee, called carried interest, to pay her bonus. But with private markets, patience is a virtue. They need on average 4 to 6 years to transform and sell. Since investments will not all happen at the same time, funds will usually be created for 10 years. Mrs. Finance will progressively deploy the capital as she selects investments and will give you back the proceeds as she sells them. The resulting fund outflows and inflows, once accumulated over time on a graph like this, will draw a curve in the shape of a J, the J curve, which shows the initial investment and the potential resulting inflows. Since Mrs. Finance will give you back the proceeds of the investment she did for you, she'll regularly come back to you to create new funds and collect fresh capital. You will then have the choice to commit to her new fund if you're happy with her results with Cupcake & Co. So whatever way they decide to secure their backing, Mr. and Mrs. Cupcake can get baking, and thanks to Mrs. Finance, they can all have their cake and eat it, even you.